Hey everyone, in this video I'm going to talk about two ways to maximize your borrowing capacity right now. There have been two big changes in the lending environment. I know a lot of you guys are struggling with your borrowing capacity because interest rates have gone up. But if you're self-employed, or even if you're not, you're just on a PAYG, these two changes from two different lenders may mean that you can get that additional investment property or additional two investment properties, or you might be able to go from borrowing 400k to 450 or 500k to 600. So carry on watching if that's you. The first one, okay, real quick, the first one is from NAB. Now what they've done is, normally banks, what they do is they say, we will shade your rental income by 20% in order to calculate how much you can borrow. So if your rent is, let's say, $24,000, they'll shade it by 20% down to, what is that, like thousands of dollars less, in order to calculate the true borrowing capacity that you have. They've just changed that to just shading it by 10%. Now that might not sound like, all that much really, but that gives you an additional borrowing capacity of around 8%. So, you might just be on the cusp, you might be like able to borrow $250,000, and that may not be enough to get a decent property. Now this will allow you to perhaps just borrow just that bit more with your deposit as well, gets you into the 300k category, which gets you a really good high yielding, high growth property. So that's the first one from NAB. Whether you're going through a broker or you're going yourself, go check out NAB. It's a big difference that it will make to a lot of you. Now this second one I'm even more excited about. Okay, I'm even more excited about. Now what this is Virgin Money. Everyone knows Virgin, right? Virgin Money is owned by Bank of Queensland. Now Bank of Queensland is a tier 1 lender. They give tier 1 lending rates. In other words, the interest rates are low. They're not like your First Max, your Pepper Moneys. They're not like your higher interest rates. The non-bank lenders allow you to borrow a little bit more, but they charge you a premium on the interest rate. Now what's amazing about Bank of Queensland owning Virgin Money, they've just changed their DTI, their debt to income ratio. So before, Virgin Money would only allow you to borrow up to 6%, on a debt to income ratio, not 6%, sorry, that's a ratio, right? So debt to income up to 6x. They've just changed that to 8x. They've just changed that to 8x. So that will allow you guys to get so much more borrowing. And the great thing is, because Virgin Money is owned by Bank of Queensland, even though they're giving higher debt to income ratios, allowing you to borrow more, the interest rate they're charging is actually just the same as a tier 1 bank like a CBA or ANZ or something like that. Okay, so you're getting more money from the bank at a cheap rate. Now that's amazing. And then the second part of this Bank of Queensland Virgin Money story that my broker friend told me, and this is hold on for this, guys, this is the main bit of the video, is if you're self-employed. Now normally, sorry, some jet skis going on in the background there. That's the main river here in the Gold Coast. Normally, if you're self-employed, you had to show 2 years of tax returns, and the bank would take the average salary or the average income from your business and assess your ability to borrow money on that based on 2 years. Now, there's just been this change from the same bank, right, whereby they're allowing people, even though their income may have been really poor in that 2-year period, they're allowing you to borrow money so long as you have two options available. Okay, so long as option 1, you have 2 pay slips, i.e. the company that you own, you're drawing a salary from, you have 2 pay slips to yourself, and you get an accountant to sign off on the fact that it's a healthy business. Okay, that's scenario number 1. And the second scenario is that you have 3 months of salary to declare. Okay, and they'll assess you based on that 3 months of salary, even if 2 years ago or 1 year ago your business wasn't that solid. Now of course you do need to be in business, have an ABN for 2 years, but they don't no longer care necessarily about how your business is performing. So there'll be like literally hundreds, I don't know how many people watch this video, but it'll literally be like thousands of people out there, tens of thousands of business owners who, you want to get a loan, you want to begin or expand your property portfolio, but because you're not a PAYG, you're a business owner, not having 2 years of good income is holding you back. Now with Bank of Queensland Virgin Money, there's not a problem. Option one, go to your accountant, get them to sign off on it, and all you need is 2 pay slips to yourself of a reasonably good enough or appropriate income that you're paying yourself from the business. Or option two, 3 months of salary. You don't need an accountant to declare or sign off anything on that. You just need 3 months of consistent income that the business is paying yourself. So this is extraordinary. Interest rates are going up. I think they're almost at the top of the cycle, but it has meant that borrowing capacity has shallowed out, has softened out, and that's meaning that a lot of you guys may not be able to borrow as much or anything enough for your next property. These 2 hacks that I've just shared with you, the first one with NAB, increasing your borrowing capacity by almost 10% overnight, and the second thing with Virgin Money, Bank of Queensland, increasing their debt to income ratio and allowing you to borrow more on a PAYG basis, and allowing business owners to borrow so much even if their business income hasn't been solid for 2 years. This is a game changer. And guys, in every cycle this happens, right? In every cycle this happens as interest rates go up. Borrowing capacity levers, borrowing capacity tactics, borrowing capacity policy changes occur, offsetting a lot of those interest rate rises insofar as being able to borrow money. Now, I fully expect, I'm on record here, I fully expect that in the next probably 3 to 6 months or something, like 8 months maybe, that buffer that banks put on you to make sure that you can repay your loan, they put a 3% buffer on. So if your official, if the lending rate is 3%, they assess you at 6%. That buffer that was forced upon the banks by APRA, the regulatory authority, back when interest rates were 0, almost 0, that buffer is going to be shrunk. And why is that? Is because we needed a buffer to withstand interest rate rises because they were at a record low. So APRA very intelligently said, well, interest rates are only going to go up, right? This was last year. Let's imply or install or implement a buffer so that when we come into this situation, interest rates have gone up, people are still good because banks have assessed them at 3% more than what they ought to. Now there's no need for that because there's almost zero possibility of interest rates going up another 3%. Of course, the CBA is saying that it might go up another 25 or 50 basis points. Other banks are saying maybe another 100 basis points or 1%, but there's no way they're going up another 2 or 3%, right? Or something dramatic would need to happen. So that buffer is going to be shrunk back down to 2%, which is what it used to be, maybe even less. If we're at record in this cycle, we're at higher interest rates. So, that all of a sudden will allow your borrowing capacity to expand organically overnight by like 10, 20, 30% as well. So watch this space. If this was valuable, guys, and you want more hacks on how to improve your borrowing capacity, how to get that next loan, which bank to bank with, if your mortgage broker isn't good, if you don't have a mortgage broker, then leave a yes below if you want more videos on this, because this is really, this is the crux of property investing. Everyone wants to know where to buy, what's the hot spot, but property is as much a lending game as it is where to buy. If you can't borrow money, who cares if the next boom hotspot that's going to go up by 20% next year? You can't borrow money to get it, okay? And there are those hotspots available. My clients will know that. Hey guys, all right, so that's basically it. Hopefully that was bringing you value, guys. Hit the subscribe button and turn notification bell on, and please go to the links below because you can level up your knowledge for free on my podcast, Google and Spotify, as well as Apple Podcasts, and also the Facebook group with 25,000 amazing people where we discuss things exactly like this. There's so many mortgage brokers in there as well. And if you engage with mortgage brokers, then they'll tell you even more tips like this. Not all of them, of course. My name's PK. Catch you later, guys. I'll see you on the other side. Bye.